Are you ready to unlock the secrets of smart investing? Have you ever felt overwhelmed by the stock market, unsure where to begin? Well, you're in the right place. Today, we're diving into one of the most powerful and accessible tools for new investors, exchange-traded funds, or ETFs. ETFs are designed to make participating in the stock market simple and diversified. They offer a straightforward path to grow your wealth, even if you're just starting your investment journey. Think of them as your friendly guide to the world of finance. So what exactly is an ETF? At its core, an ETF is an investment fund that holds a collection of assets. These assets can include stocks, bonds, commodities, or a mix of different investments. What makes them unique is that they trade on stock exchanges, just like individual company shares. This means you can buy and sell them throughout the day, whenever the market is open. They offer a flexible and dynamic way to invest. An ETF is essentially a basket of securities. Instead of buying one stock, you're buying a tiny piece of many different stocks, or bonds, or other assets, all bundled together. This structure makes them incredibly versatile. This basket can be filled with various types of investments. It might hold shares of hundreds of companies, or a selection of government bonds, or even a mix of both. The specific contents depend on the ETF's objective. To make this even clearer, let's use a simple analogy. Imagine you want to make a delicious meal, but you don't want to buy every single ingredient separately. That would be time-consuming and potentially expensive. Instead, you could buy a pre-packaged meal kit that contains all the ingredients you need, perfectly portioned. An ETF is like that pre-packaged meal. You purchase the entire meal, the ETF, with a single transaction. This avoids the hassle of buying individual ingredients, or in our case, individual stocks. One of the most immediate and significant benefits of ETFs is the instant diversification they provide. When you invest in an ETF, your money is spread across numerous underlying assets. This means you're not putting all your eggs in one basket. This diversification significantly reduces your risk. If one company in the ETF's basket performs poorly, its impact on your overall investment is minimized because you own many other assets. It's a smart way to protect your portfolio from the volatility of single stock performance. One of the biggest reasons ETFs are so popular, especially for beginners, is they're typically low cost. They often have what are called lower expense ratios. An expense ratio is the annual fee you pay to the fund manager for operating the ETF. These fees are generally much lower than those of actively managed mutual funds. This means more of your investment returns stay with you, the investor, rather than being eaten away by fees. Over time, these lower costs can make a significant difference in your overall investment growth. ETFs are created and managed by large financial institutions. These institutions design the ETF to track a specific index, sector, or investment strategy. They then create shares of the ETF, which are bought and sold by investors like you. The fund managers ensure that the ETF continues to hold the assets it's designed to track. They handle all the complexities of managing the underlying portfolio, so you don't have to. Your job is simply to choose the right ETF for your goals. Many ETFs are designed to track a specific market index. For example, an ETF might aim to mirror the performance of the S&P 500, which includes 500 of the largest U.S. companies. Others might track a specific sector, like technology or healthcare. Some ETFs even track specific investment strategies, such as those focused on dividend-paying stocks or environmentally friendly companies. This tracking mechanism allows you to invest broadly in a market segment without picking individual stocks. It's a hands-off approach to market exposure. When you buy shares of an ETF, you are essentially buying a small piece of all the underlying companies or assets that the ETF holds. You don't directly own the individual stocks, but you own a share of the fund that owns them. This is similar to how you own a share of a mutual fund. This indirect ownership is what provides the diversification and simplicity. You gain exposure to a wide range of assets with just one purchase. It simplifies the investment process immensely. We've touched on this, but it's worth emphasizing. Diversification is key for new investors. ETFs inherently offer this by spreading your investment across multiple assets. This reduces the risk associated with any single investment performing poorly. Instead of worrying about one company's stock price, you're investing in an entire industry or market segment. This broad exposure helps smooth out the ups and downs of the market. It's a foundational principle of smart investing. As mentioned, the low expense ratios of ETFs are a huge advantage. For beginners, every dollar saved on fees is a dollar that can continue to grow in your portfolio. These cost efficiencies can significantly boost your long-term returns. Compared to many other investment vehicles, ETFs offer a very cost-effective way to gain market exposure. This makes them an excellent choice for those just starting out with smaller investment amounts. You get more bang for your buck. ETFs are traded on stock exchanges just like individual stocks. This means they are incredibly easy to buy and sell throughout the trading day. You can place orders using your brokerage account, just as you would for any stock. This liquidity and ease of trading make them very flexible. You're not locked into a fund for a long period, unlike some other investment products. You have control over when you enter and exit your positions. Transparency is another major benefit of ETFs. Most ETFs disclose their holdings daily, or at least very frequently. This means you can always see exactly what assets the ETF is investing in. This level of transparency allows you to make informed decisions. You know precisely what you're putting your money into, which builds confidence and understanding. It removes much of the guesswork from investing. ETFs are widely available through most online brokerage accounts. Many brokers even offer commission-free trading for ETFs, meaning you don't pay a fee to buy or sell them. This makes them incredibly accessible to anyone with an investment account. You don't need a large sum of money to get started either. You can often buy just one share of an ETF, making them suitable for investors of all budget sizes. This low barrier to entry is perfect for beginners. ETFs come in many different flavors, each designed to meet specific investment goals. Understanding the common categories can help you choose the right ones for your portfolio. Let's explore a few popular types. Index ETFs are perhaps the most common. These funds aim to track a specific market index, such as the S&P 500, the NASDAQ 100, or a global stock index. They offer broad market exposure with minimal effort. Sector ETFs focus on a specific industry or sector of the economy. For example, you can find ETFs that invest solely in technology companies, healthcare providers, or energy producers. These allow you to target specific growth areas. Bond ETFs invest in a portfolio of bonds, which are essentially loans made to governments or corporations. These can provide a more stable income stream and are often used to balance out a stock-heavy portfolio. They are generally considered less volatile than stock ETFs. Commodity ETFs track the price of physical commodities like gold, oil, or agricultural products. These can be used to diversify a portfolio beyond traditional stocks and bonds, offering exposure to different market drivers. They can act as a hedge against inflation. While ETFs simplify investing, it's still crucial to do your homework before you buy. Always understand the ETF's underlying holdings. What companies or assets does it contain? Does this align with your investment philosophy? Also, pay close attention to the expense ratio. Even small differences in fees can add up over time. Finally, identify the ETF's investment objective. Does it aim for growth, income, or something else? Make sure it matches your goals. Before investing in any ETF, take a moment to consider your own risk tolerance. Are you comfortable with market fluctuations, or do you prefer a more conservative approach? Your comfort level should guide your choices. Align your ETF selections with your financial goals. Are you saving for retirement, a down payment on a house, or something else? Different goals may call for different types of ETFs. A clear understanding of your objectives is paramount. ETFs are undoubtedly a powerful tool for building a diversified and cost-effective investment portfolio. They offer an accessible entry point into the market for beginners and seasoned investors alike. They truly democratize investing. However, like any investment, ETFs come with risks. Their value can go up and down with the market. There are no guarantees, and past performance is not indicative of future results. But with proper research and a clear understanding of your goals, ETFs can provide a fantastic starting point for your investment journey. They empower you to take control of your financial future. So, are you ready to start exploring the world of ETFs?